All right, so the moderator of our panel is Mr. Kelley Bergstrom. He's the namesake of our center. He's the president and CEO of Bergstrom Investment Management, where he invests on his own account in real estate, private equity, venture capital, and many other things. Prior to that, he was president and CEO of JMB Property Corporation, which was the property and leasing company of JMB Realty out of Chicago. He is a alumni of the University of Florida. He's a tremendous supporter. He was the chair of our advisory board 2 years ago, and is now the chair of the UF Foundation. And we are honored to have him as, I believe, our first inductee into the Hall of Fame and moderating our panel of Hall of Fame recipients. So with that, Kelley.
Can everybody hear me? Sounds like the microphones are working. I want to thank Tim Becker and John Crossman for really a great job in organizing this whole two-day conference. I think everybody has really enjoyed themselves, and we really appreciate the job that's been done. Today we've heard what I would call the macro story from a variety of people. We talked about the national economy, we talked about the Florida economy, the impact of both public and private real estate that we're all involved with going forward. Now what I would like to do is kind of shift to the micro side. As individuals, we have to work at this climate, and we have to go forward and find something that we think will be appropriate to do. I'm delighted that I'm joined today with 5 of our Real Estate Center Hall of Fame members. Before getting started, I want to thank them for being a part of the panel and telling us about their personal strategies and their successful business careers. We're going to divide the program really into 2 parts. First, I'm going to briefly introduce each panel member and ask them to tell their business story. What were the key things along the way that got them to where they are today? I'd like to just mention a couple of things about myself. As Tim mentioned, I graduated from the University of Florida with my MBA. I have a concentration in real estate. And first job out of school, I joined IBM Corporation in their real estate and construction division. We were the world's largest, probably by sales, corporation at the time, very successful company as it is today. But I was in the division that was the smallest one of the company. We did all of the real estate activity, primarily leasing office space, building plants, and providing the housing for the corporation. A couple stories that I think set the tone here. The second day on the job, I'd been there, it was probably 10 o'clock in the morning. Jack came over to see me. And Jack was the guy in the office that did all the financial stuff. And in those days, this is the early 70s, he wasn't a college graduate. He was way down in the ranks. And about 10 o'clock in the morning, he comes over to me second day and says, you know, I want to teach you the success of IBM Corporation. So I thought about that for a minute. Here I am. I've been on the payroll for 26 hours, and now I have the secret of this international company that has been so successful. And basically, it boiled down to they had a very well-trained, motivated, incentivized sales force. And every year, IBM salesmen were supposed to get their quota and bring it in. And of course, most salesmen, they basically want to make the quota that year, and once they get there, start working on next year, which is going to be a little bit more. So basically, the corporation set the top line. Then the financial guys took over and said, hey, we are a public growth company. We want to show people that we're growing, and we want to have a bottom line that looks appropriate. And that left the middle line, the expenses. And Jack said, we're part of the expense program. We do the real estate. Obviously, most of the expenses were sales and salaries, the manufacturing facilities, but we had all of the retail activity. And he said, that's the secret to the company. We set the sales, we establish what our earnings targets are, and we have an expense budget that everybody down in the ranks is expected to follow. I said to myself, that's really interesting. Here's Jack, 9 layers in the organization chart, but he was like all of the 150,000 IBM employees. He was a part of the plan, and that always stuck with me, that here was a big organization, but down in the ranks, everybody understood what their role was, even if it was relatively small in the overall. The second thing was 2 weeks later, the guy that I was going to eventually replace, his name is Clem, came to me with a great big inbox of invoices that IBM was getting ready to pay. I think the total was like $850,000. This was escalation billings for operating expenses and real estate taxes. And he said, you know, I've got this stuff all ready to go, but the boss has said, why don't you take a look at it? So I get into all these stack of invoices. In those days, it was all paper. And so that generated me going in and reading all these leases. So fast forward, after I got done, after about 4 days of staying in the office till 10 o'clock at night, I found a savings of $125,000 that we did not have to spend because the billing by the landlord was incorrect. So I tactfully went to Clem, we both went to the boss and said, hey, we found some things here, we can reduce the size of the bill. And the point I'm really saying to people that are starting out in the middle of their careers, even the nastiest tasks, the extra things you have to do at night can sometimes be an instrumental part of getting started in your career. So hopefully the flavor of that and some of the other things of our very distinguished panel will come across as ways for you to be successful in your individual career as they profile their individual careers. So that's the first part. The second part is after we ask them about their personal success story, we're going to talk about their best investment ideas for 2013. What are they doing right now, going forward? Where do they see the opportunities for the individual? And after that, we'll open it up for questions and answers from the audience. So if you have anything that comes up, jot it down, and we'll be happy to entertain those questions. My introductions have been shortened to a few business and personal highlights. I must say, as a group, they have not only accomplished in business, but have excelled in life. Charitable involvement, numerous nonprofit boards, giving back to their communities, universities, and families is the one common trait that each Hall of Fame member demonstrates and should be commended for. So I'm going to start with Hap Stein. You kind of heard some of his profile before, but I'm going to kind of repeat it. Some of the people were not here in the morning session. Hap is chairman and CEO of Jacksonville-based Regency Centers, a real estate investment trust specializing in grocery-anchored and community-sized shopping centers. Regency has grown into one of the largest retail real estate companies in the United States, with 367 shopping centers totaling 50 million square feet. Hap has served as chair and on the boards of several national real estate organizations, including the National Association of Real Estate Investment Trusts, the Urban Land Institute, Real Estate Roundtable, and the International Council of Shopping Centers. He's a graduate of Washington and Lee University and Dartmouth College. Hap serves on the board of directors of Patriot Transportation, Rock Industries, and Stein. Hap, tell us your story.
Thank you, Kelley. And I was going to say, I should say thank you for not having to follow all the giants that are up here. But however, you really are an amazing man, and I am so proud to call you a friend, Ron. As you may have heard, and gosh, this is the second time some of you have had to endure me today, but anyway, this is our 50th year, Regency's 50th year in business, and the company was founded by my parents back in 1963. Our first major development was a regional mall in Jacksonville, Florida, the first major regional mall called Regency Square Shopping Center, hence the name of the company. Once the mall opened in about '67, I joined the company about 10 years later. So I showed up at work the first day in my Wall Street weegens, my suit and tie. And as Armando knows so well, my father had a way with very few words, and he said, "Wrong again, son. You're going to start in the total energy and utility plant working, and that provided the air conditioning, electricity, and water and sewer for the mall." And I got to work with a bunch of wonderful Navy boiler chiefs, and that was the way I started in the business. I became a property manager, leased the expansion of Regency Square Shopping Center. It became pretty evident that we could not compete with the Simons, DeBartolos, and CBLs of the world. And so we decided to sell the shopping center. And then we were smart enough at the time not to try to compete in the multifamily business with Ron and Jim, but we decided that we would go down and be in the office business and compete with these two local sharpshooters in South Florida, the poor Cuban refugee and Terry Stiles, Armando and Terry, and we got sent back up to Jacksonville kind of with our head between our tails. But fortunately, in the meantime, we had kind of discovered the community and neighborhood shopping center business. We liked the attributes that you heard from Chris Lee about the business, its recession-resistant nature. We liked the anchor. We liked the fact that you had to have an anchor to put some sort of a cap on new supply, because as you know, many of you are developers. We in the development business are not the most disciplined group of people in the world, and there's another story about that. But anyway, the company grew, expanded. You know, we survived the downturn and went public in 1993 with a $150 million market capitalization with a focus on community and neighborhood shopping centers. And we've since grown to a market capitalization today of pretty close, $7.5 billion, 400 shopping centers, about 45 million square feet. And kind of, you know, what are the lessons kind of learned through that, you know, that process? And it is, once again, I said this, and I'm sorry to bore you, but it is repeat. It's quality of assets, shopping centers with sustainable competitive advantages that are going to produce that predictable cash flow. Disciplined development is a great way to create value, but you gotta be disciplined about it. You don't make mistakes when times are tough, when you're coming out, but you need to remember when times are really good that you even need to be more disciplined. Thirdly, a conservative balance sheet makes all the difference in the world. And finally, and most important of all, some people say that real estate is all about location. It's all about people. And people do business with people. And you gotta, especially in today's interconnected world, is focus on those personal relationships.
Let's go on to Jim Pugh. Jim is owner and chairman of Epoch Properties, a multifamily housing developer based in Winter Park. Epoch has developed over 30,000 housing units in 56 cities in Florida and California. They have been annually ranked as one of the top 50 multifamily builders in the United States. Jim is a graduate of the University of Florida, served as an infantry company commander in the U.S. Army, which we share, and is an instrument-rated citation jet pilot with over 4,500 hours of flying time. Jim, tell us how you got from the Army into the real estate business.
Well, first of all, to the young people out in the audience, you look up here and see all these old guys. Let me just tell you that if you do something long enough and you don't screw it up too much, you'll be sitting up here someday. So just keep yourself together. Kelley, a couple things have defined my life, and you mentioned one. I did the ROTC thing at the University of Florida and was a captain in the Army, an airborne ranger, and special ops. And if you don't know what special ops is, those are the guys that took out Osama bin Laden. And so, you know, you learn to think the way a special ops guy does, and that makes you very competitive. And I guess in the world of where I live, it is very competitive. And we have built a few apartments. Ron over here builds more in a year, and we built in our whole career of 43 years. And congratulations, Ron, for being here. It's a big deal. Thank you. The other thing that defined my life is that after I got out of the Army, I was 26 or 7 or somewhere in there, and I went to work as an estimator for a general contractor. And we were moderately successful, but I did learn the basics of construction and those kinds of things. But what I really learned most was the guy I went to work for was hugely, he had a huge amount of integrity. He was the most honest person I've ever known in my whole life. And you know what? I learned to do it the right way. I learned that you can be honest and forthright, and as the guys will tell you, that's a very important part of business, is doing the right thing every day. We'll talk about the things that we do in our business in the next stage, but I would say that what Kelley mentioned of giving back is just a huge part of every life up here. And I spend today about half to 3/4 of my time doing civic things. And my job today is I'm the chairman of the $500 million Performing Arts Center, and I see a few of you out there that are a part of that also. So we have to go out and raise money every day. We're under construction, and it's going to be a changing event for downtown Central Florida. But anyway, thank you for having us, and we'll pass it on. Thanks, Kelley.
Okay, thanks, Jim. Let's go on to Terry Stiles. Terry is chairman and CEO of Fort Lauderdale-based Stiles Corporation. Stiles is a full-service company that has developed and operates 37 million square feet of mixed-use office, industrial, retail, and residential property. In addition to extensive holdings in Broward County, Stiles Corporation has a presence in Miami, Tampa, Orlando, Jacksonville, and Fort Myers. Terry has served as president and on the boards of several national real estate organizations, including the National Association of Industrial and Office Parks and the Building Owners and Managers Association. So Terry, tell us how you got started in all this.
Well, thank you. First of all, Ron, I want to congratulate you as well. Your story is phenomenal. And I'd also like to thank the center because, as I said last night, we're kind of the end product, or we're buying your end product from the school. And we've had a tremendous amount of success with the students that we've hired and put them right into our system. And they've been phenomenal. A couple of them are here today. So our company is probably the oldest company here. We were founded in 1951, so we're 62 years old. My dad started it. It was a small construction company. I joined him in 1968 when he had his third heart attack, and then unfortunately he passed away in 1971. And at that time we were 2 carpenters and a laborer, and unfortunately I was the laborer, so I went from being the laborer to trying to figure out if the receptionists remember who I was. But we slowly grew the company, adding the disciplines that we felt was necessary to have a full-service real estate company. We had an architectural company, we were a construction company, we had a capital company, property management, leasing. And so today we feel like we're one of the few full-service firms in our marketplace. And it's, we think it's a big leg up for us. A couple of things just talking about how we got to where we are and what kind of made our success. You know, the first thing is my father taught me that our name and our credit are the 2 most important things you have to protect. And we have done everything we can to stay in the good stead of that. I learned a long time ago from a guy by the name of Ken Behring, who was a used car salesman who became the developer of the city of Tamarack and went on to own the Seattle Seahawks, that he may not be the smartest guy in the world, but he could hire him. And so that was one of my philosophies. This is when I was about 26 years old. He told me this, and he says, you know, go out and hire the best people you can. And we did do that. And we now have got a great group of elder people and also a new young core of people. And so that's been a big part of our success. Also the relationships we've developed over the years. And to me, if you're a young person coming up, you got to savor the relationships you make. Dan Finkel, I always embarrass him at these meetings, but his grandfather walked into my office back in about 1972. He had retired from an automobile parts company, and he was tired of playing golf, and so he gave me my first shot of building a warehouse that was 35,000 feet. We nurtured that relationship, and he almost became my dad after my dad died. We built a tremendous amount of space together, and we were partners for 38 years when he passed away at the age of 93. It was a phenomenal relationship. We built over 1 million square feet for IBM. We did most of the PC construction in that partnership. One day, a little girl walked in my office, and she goes, I've got a company that would like to invest with you. I go, who's that? She goes, Olympia, New York. I go, who's that? She goes, Olympia, New York. And so 10 days later, we were partners with Albert Reichman, and they were our partners in Corporate Park. Wayne Huizenga, the owner of the Dolphins, he's been my partner for over 35 years. Probably over 5 million feet of various product types. We actually expanded Dolphin Stadium. We gutted it, expanded in both directions 80 feet, all while we did 81 baseball games and 16 football games. So. And then Steve Halmos, owner of Safeguard, we built their corporate headquarters, became a main partner. But anyway, the key is that the relationships you grow through your career are extremely important. Some of our key projects, we built 1 million feet for IBM. Corporate Park at Cypress Creek was the first office park in South Florida. We went on to do North Point Corporate Park, Sawgrass International Corporate Park. We did over 2.6 million square feet in downtown Fort Lauderdale, which is where we are today, and is one of the things I'm most proud of. And then we've had a great relationship with Publix supermarkets, and we built over 26 centers with Publix. We were fortunate. They selected us to go into Charlotte, and last year we went in and found 10 sites, and we are now developing 3 Publixes in Charlotte. We also, being a full-service company, we don't have to develop to make money. So our third-party work's very important to us. Our construction, our property management, and leasing keeps our lights on. And we've done a tremendous amount of public work as well as third-party work. We do all of City Furniture's work and all of Eldorado Furniture's. A couple of things that I've learned through my career is you got to build a culture that you believe in with your people, and you've got to take care of your people, and you've got to create a place that's a great place to live. Your image is huge. Mr. Finkel one day walked into my office, and we had a landscape company, and he goes, I want to show you something. He says, come outside. And we had a landscape truck that was filthy. He goes, this is a reflection of your company, and if you keep your equipment and your job sites like that, then it's going to be a negative. So keep your image clean. Giving back is a huge part of what we do. Being involved with the community is a huge part of what we do. And it also leads to relationships that become a factor of a way of getting business. It took me 9 years to get Mike Jackson to allow us to build the AutoNation corporate headquarters. He said I was the most persistent guy he's ever met. We learned that you build to the highest quality you can in your marketplace. You don't reinvent the wheel. Early on, we went to California. We photographed everything we could and came back and built it at Cypress Creek. I always said that my Canon AE1 was my best designer. You got to remember through the tough times. I've been through 3 cycles. 91, Jim and I fought this thing out. We were about $140 million underwater. We negotiated with every lender we had, and we worked our way back, and those lenders today are loaning us money. And you don't let your past drag you down as well. You got to learn from your past, but you got to build on your past. And then also going back to the people part, make sure they're on your team, incent your people so if they make money, you make money, and also just make sure you celebrate their successes both personally and as a business person, and make sure that they feel like they're part of your family. Then also lastly is you need to communicate as much as you can with every element that you work with, whether it's your employees, whether it's your partners, whether it's your spouse. You need to communicate more than you ever thought. So even if it's bad news, you need to tell them. So with that, thanks again.
All right, thanks, Terry. Let's move on to Armando Codina. Armando is Chairman and Chief Executive Officer of Codina Partners in Coral Gables. Previously, he served as Chairman of Flagler, a full-service real estate firm, and prior to that, he was CEO of the Codina Group that grew into the largest privately held commercial real estate firm in Florida. In 2006, Codina was merged with Flagler, which was then part of Florida East Coast Industries, which was then sold to Fortress Investments in 2007. Armando, I think you had a pretty good timing on that one. So before getting into real estate, Armando was president of a firm created to provide data processing services to physicians. He is recognized as a pioneer in the development of medical management systems. He is currently on the board of directors of American Airlines and Home Depot. So Armando, how did you get your start in all of this?
Kelley, first of all, thank you on the center. I was very impressed with Ron's, particularly your message, I was very impressed with. And I've known Hap for a long time. His father wouldn't come to Miami without stopping by to visit me. I met Jim last year. It's a privilege to be up here with the three of you. Terry's a little bit different privilege for me. I don't like these panels particularly. I don't do too many of them, but every one of the ones that I have done, Terry has been on the panel. So I have a suggestion for you. Next time, we're one of these. Maybe you tell my story, and I tell your story, but I want to go second. I felt, not crazy about these things, but I felt at home a little while ago when you were making the presentation about the Hispanic market, and I'm glad I kept going to Berlitz to keep my accent. It sounds like I'm going to be more popular in a few years. So if you want to, the main reason for whatever success I've had, I attribute it to one thing, that I was lucky enough that Cuba was 90 miles from the United States. So if I live here 100 years, I can't repay what this country's done for me. So that's the most important thing. So I came as an accompanied Cuban child. My mother and father couldn't get out of Cuba at the time. I was in a place, a camp for unaccompanied Cuban children here in Miami. Ended up in an orphanage and a foster home in New Jersey, and was reunited with my mother in Jacksonville. Worked at a grocery store and at a bank, and I had the good fortune later to be on the board of directors of Winn-Dixie and Barnett Banks. So, as you can tell, I get a little, he told the story, but it means a lot to me. But anyway, I founded a medical billing business because I saw the need that doctors had. Founded in 70, sold it in 78. Ross Perot wanted to buy it. Unfortunately, there was another Texan by the name of Clint Murchison who also wanted to buy it. And their egos got in the way, so they paid me a lot of money and sold it.
He's real good at it.
I thought I was going to retire. I told my wife I was going to retire. I met Bush 41, ran his campaign against Reagan, the primary. My father had been a politician, so I thought I wanted to be a politician, but running that campaign for a year cured me of that disease. I had a very, very, very tough non-compete. After I did the political, I worked for Bush for a year and a half. I did a lot of civic work and wanted to get back into business. I had a very, very tough non-compete. The guys that I sold to only wanted the billing part. We were the first company to have done a computer form on a computer. That's on a Medicare form on a computer, an insurance form on a computer. The first company to send a magnetic tape to Ross Perot at EDS. He used to manage Medicare. So that's how they came to want to buy it. So I couldn't get back into any parts of the business, but the last 3 or 4 years of my computer business, we had done so well for the doctors that they depended on us for a lot of things, including office space, leasing equipment. So I got into the real estate business purely by accident. I began doing some real estate deal with my doctors, built a lot of medical office space, and evolved to what has been described. At one time we were, in the late 90s, early 2000s, we were the largest commercial developers, even though I only developed in Dade, Broward, and Palm Beach County. It was tough to go to Broward with Terry. But I used to tell my guys if I couldn't get there, touch it and come back and have lunch with my mom. I used to have lunch with her Monday through Friday. It's too far away. We had a brokerage firm that, even though we were an independent, was larger than the nationals for a number of years. And our management company was larger than 2, 3, and 4 in the marketplace. So in 2006, May of 2006, I merged with Florida East Coast Industry as the company that Henry Flagler founded when he brought the railroad. And I always lost it after their land holdings. I got on the board. I was the largest private shareholder, and quickly felt that it was a company that was not well understood. It didn't trade. There was not a lot of trading because the markets didn't know if they were a real estate company or a railroad. They were not a REIT. So I was fortunate enough to push, and we sold it to Fortress. So we merged, when we began the conversation, their stock was about 29. We merged with them. It was, the deal was on the 30th. And we sold the company a year later at 84 to Fortress. So I retired one more time. Told my wife I was going to retire. We were driving on I-95 when I got a call, said, you know, the transaction closed. And I said to my wife, you know, I'm really going to take some time. I'm going to retire. And she said, sure. So I formed the Codina Partners. I've had an attorney that's represented all the big developers, including Terry, for many years. Larry Gragg of White & Case, and I went to Larry and said, do you want to be a partner in Codina Partners? And come and join me so you can be a mentor to the children. Larry, where's Larry? Larry, can you get up for a second? Where's Larry? As you can see, he's much older than I am. When I was a kid. So we have bought, we've been busier than I have ever been in my life because we bought a lot of bonds at the height of the distress. We bought a lot of CDD bonds. And then we ended up buying a lot of debt. We have bought a lot of land, so we have a pretty active pipeline of development. So that's the story.
Okay, thank you, Armando. Moving on to Ron Terwilliger. We've just heard from Ron as our most recent Hall of Fame inductee. But let me just recap his achievements. Ron is Chairman Emeritus of Trammell Crow Residential, a firm that has dominated multifamily development for over 40 years. He joined Trammell Crow in 1979 after serving 5 years in the Navy and graduating from the Naval Academy. Over the years, Ron has been involved with and served on the boards of several national real estate associations, including the National Multi-Housing Council and the National Association of Home Builders. He additionally is Chairman Emeritus of the Wharton Real Estate Center. Literally anybody who's been in the multifamily business knows about Ron, and I want to extend my congratulations in receiving the award and being here with us today, Ron. Since you've already kind of heard his story, I'm going to let him do what he wants to do, but one of the things that Ron is getting some very good publicity on, and I don't think he's looking for publicity, but the idea of his involvement with philanthropic things in the housing area and workforce housing. So Ron, I'll let you touched upon those before, but you may want to add to it.
Yeah, thank you very much. I may go in a little different direction. I have had this retirement thing, Armando, like you, but when I told my wife I was going to retire, she said, you know, hon, I married you for life, but not for lunch. And so I kind of decided maybe I would keep being busy. I thought, since you've heard about the philanthropy and my passion for affordable housing and education and just helping people, I talk a little bit about my journey in a little different way. I started out of business school with absolutely no business experience. You know, 9 years in the Navy, 2 years at business school, and so I went to Hilton Head Island to Seapine's company. Charlie Frazier was recruiting young business school oriented people, and I came in as a financial service officer. And week before last, Peter Rummel and Jim Chapin, Jim Light and I went back to Hilton Head for the ULI to talk about what it was like in the early 70s. It was a lot of fun, kind of re-envisioning what happened. Charles Frazier, the founder, God bless him, passed about 10 years ago, but some great people came out of there, including Harry Frampton, who many of you may know. I thought that when I got there, I was going to get a good explanation of how to go about doing business, because they put me in the finance area. And they first explained to me the developer's creed. And some of you may have heard the developer's creed. A dollar borrowed is a dollar earned. A dollar refinanced is a dollar saved. And a dollar repaid is a dollar lost forever. So that's how we went about it at Hilton Head. We had no equity base, but Charlie had an expansive dream. He conceived the Sea Pines Plantation, which his father had owned and was able to inherit that. And with a lot of bartering, swapping oceanfront lots for development work, etc., he was able to build a little bit of momentum at Sea Pines. And he wanted to go beyond that, so we began borrowing from the mortgage REITs of the early 70s. And incidentally, for the students here in the audience, I've written an article for the Wharton Real Estate Review, spring of 2011, kind of about my 40-year career in real estate development. And so you might find some things interesting there. I tried to put down all the lessons learned, including the fact that when you borrow 100% of your cost at 5 over prime floating, it really is a loan to own. It's just a matter of when. So not many of you are old enough here to know what happened in '74, but back in the day, the Fed shut down inflation by raising rates, and we went to 12.5% prime, so our borrowing cost went to 17.5%. The market, which was a resort second home market, primarily we were living on lot sales. The market fell to 10% from 73 to 74. Sea Pines was pretty much out of business. So I was shell-shocked, you know, I was just 30-ish and trying to figure out what to do about real estate. I ended up taking a job in Dallas, Texas with the Henry C. Beck Company. Sea Pines had gone public. Another lesson I learned, different from, of course, the REITs of today, was back then, for a highly cyclical second home discretionary company to be public was insanity to begin with. There's no predictability of earnings, so that didn't work out so well either. But I moved on to Henry C. Beck Company, which I thought would be a conservative private company. And I remember I got there, and the large commercial contractors, their revenues lagged because they sold a lot, they signed a lot of contracts in '73 and '74. So when I got there in '75, I remember my first board meeting. I was the chief financial officer. I negotiated to be on the board. I went to my first board meeting, and the president and CEO came to the meeting and said, you know what? We're sinking like a rock, and I don't know what to do about it. And he told the board that. But he was gone in about 30 days. Henry Beck owned the company. And so I went through 3 years of working in commercial construction. Good supplementary education for a developer. I learned what the difference between a fixed price contract and a cost plus guaranteed max. And when I worked at Crow subsequently, we pretty much always built our own products. So I knew generally what the process at least was for construction. You know, I still don't know the difference between a truss and a joist, but I used to be able to run these companies from a business standpoint. So it was a good experience, and you know, we waded through the down cycle. The market came back pretty strong, and one other big lesson I've learned, maybe the most important lesson, is that we work in a cyclical economy. The cyclicality affects different industries differently. Sometimes asset managers and property managers even benefit, but a merchant builder suffers much. So at Sea Pines, it bit us. At Beck, it was a problem coming in, but the market came back. I transitioned from there to the Henry C. to the Trammell Crow Company I met Trammell, who I don't know if anyone here has had the pleasure, but what a great man, charismatic guy, generous man. I remember going in there, talking about how you got into the business, because this was my business that I was at for 30 years. And Terry Golden, who was a great man, a business school classmate of mine, asked me if I would leave Dallas and move to Atlanta to rebuild the Crow organization in the eastern U.S. And I agreed to do that, and they were going to allow me to own, I was 38 at the time, so I wasn't a kid, but I was going to own 40% of what we call Crow Terwilliger Company. And the first deal we were going to do was a condo conversion down in Kendall in Miami. And so Trammell's proposal, or Terry's proposal to me was, you know, we would do the deal, and my new company, which he was funding, would get a 10% incentive. And so I said, well, I don't think that makes any sense. Why doesn't the company buy the apartment project for what it's worth as an apartment, and then the company, which Trammell owns 40% of, would have whatever upside there was. So he said, you know, you're going to have to ask Mr. Crow about that. So I'm kind of walking into the offices, and big open office concept. You ever seen the way the Crow organization used to work? And I walk in there, and so Terry says to Trammell, you know, Ryan has a different approach to how we might get started in the Crow Terwilliger Company. And so I explained my business school logic to him. And Trammell looks at me and said, son, I don't owe it to you to make you rich right away. Are you with me or aren't you? And I thought, well, that was a moment of truth. And it didn't take me long to say, yes, sir. Apologize for the idea. And the rest is history, as they say. So as I said briefly earlier, I loved it. I very much am indebted to the Crow family. Harlan's been my partner in recent years. Trammell was a generous man. You know, he genuinely wanted his partners to get wealthy. He was a rising tides guy. Align your interests with your partners. He wanted to work nationally, as did I when I eventually took over 5 years later. But I wanted my partners to do well too, so that the thing that was scariest to us was a young partner who didn't have any skin in the game. As Don Williams used to say, you know, they just throw it against the wall and see if it would stick. They liked everything they saw. But I had great senior partners and division partners, some of which are in the room here today. And we had a great culture, I thought. It was a lot of fun. We worked hard. We played hard. I'm forever indebted to Trammell and his family for the partnership. And when you can align your interests with people like that, and you need to align your interests as best you can, of course, with your investors and your lenders, it's a really good model for doing business. So I stayed there until, you know, as I mentioned, 2008, and I retired from Crow, and we'll talk a little bit more later about what I'm doing now. Thank you.
Okay, thanks, Ron. I'd just like to make a couple of points. First of all, nobody up here started out as the CEO of anything. You can kind of tell. Many of us are the first one in our families to go to college. Several of us were military officers. You know, got $200 a month when we first started our first job out of college. The junior carpenter was one, as I remember. Somebody worked in the utility plant. So, you know, that's the way it is. You start out, but then you start to look for opportunities as you go along. We've been doing this for most of us for 40 years. We've seen cycles. The one we're in now is probably one of the more difficult ones, but we've seen other times. I think Ron talked about the high interest rates before, and we've seen difficult markets, and we've seen situations that we had to work our way out of. So I just want to give you a word of encouragement. You listen to a lot of the macro stuff today, and there are a lot of things out there that you have to be concerned with, but there are opportunities as we go forward to demonstrate what you can do and opportunities where you can grow and develop your career. So now we're gonna switch gears now that we've kind of gotten to know everybody and talk about investment strategy going forward. We're going to ask the panel for their best ideas for 2013. What are they currently working on? Where do they see the best possibilities today? And I'm going to kind of reverse the order. And I guess that means I'll start with you, Ron, and then we'll just kind of go back down through the line.
Thank you. Well, as you all, I think, know, my career has been in residential, and while I've been in the for-sale business off and on, including the condo business and the condo conversion business, I've mostly been in multifamily rental. At Trammell Crow Residential, the franchise was more or less whatever we wanted to do in residential. Trammell Crow Company or Trammell Crow Commercial, we're in office, retail, industrial, and so we thought only about that. And I've been through all of these things, including the land development business. I like the risk-adjusted reward best in multifamily rental. Kind of felt like over time, it's a fundamental human need, as we were hearing earlier today. Chris was talking about the demographics, and so what I have decided to do in the time I'm engaged in business now is to invest back into the rental apartment development business. There's a lot of talk about early overbuilding, and there is some concern. Washington, D.C. may be getting a few too many units for a short time, but a lot of times people lose perspective. You know, just as in the 90s, we didn't build much in 91, 92, 93, and we had a rip-roaring time from 94 on. I mean, the unleveraged yields for product we started in 94, 95, and 96 was double-digit for us back then. Cap rates were a lot higher, so it wasn't the windfall it would be with today's cap rates. So I think we're in the third or fourth inning of the development cycle for apartments. Just a little bit of the arithmetic I always think about the spread between the yield with current rents and the cap rate as if the project were in the market today. And that should be, in my opinion, at least 150 basis points. If it's more, terrific. Not relying on, you know, rent growth during the construction process. If you get it, it makes it even better, unless the cap rate goes up during the construction process. So we're looking at markets around the country. I'm in the process with the Crow family of selling off all the assets that I've owned across the U.S. Seattle, we had a couple of infill assets going in the low fours, you know, on trailing 90 days. Some rent growth clearly in Seattle, although a little bit of concern of overbuilding, but rent growth's been 6-7% in good assets. So what I've thought there's an opportunity to do is to get in and build new apartment developments. And I've got in my own mind, and it'll be interesting to see if I can hold this discipline, that when I have to start trending rents to justify new construction, that's when I ought to stop. Because in the cycles, and I've been through, like these gentlemen up here, a lot of cycles. You know, the way it starts out is the banks will only lend you 65% of cost. And by the end of the cycle, they'll lend you somewhere between 85 and 95% of cost. And more people can enter the business. So at Crow, our motto was, much to the chagrin of my younger partners, we're going to get rich slowly together. You know, we're not going to do what the Trammell Crow Commercial Company did that got them out of business, which is guarantee 100% of fully spec office buildings. We're going to put 25% equity in our deals, or 30%, or 35%. And we're going to give away as much of the deal. A good friend, Jim Mahalso's in the room. We've done probably 50 joint ventures with Crew, and each of us have made a lot of money on them, but we've had good discipline on how we've gone about it. So I think there's a real good opportunity in the near term. I don't know how long it'll last. My guess is it'll last longer than the pundits think, because demographics are great, and we're catching up for no construction to speak of in 2009 and 10. You heard it here first. I think there will be an opportunity for condo conversion at some point. There is one that my wife and I are investing in Washington, D.C. right now, where there have been no condos built where I grew up in Arlington for a couple of years, and we're just buying an apartment that's getting finished and immediately going to put it on the market for sale. The advantage of the condo conversion business, which is great to sell into if you're an apartment developer, is that it's a short cycle business, so you don't get trapped in something that takes 3 or 4 years to conceive and build and then deliver it into a lousy economy. So I think that's another opportunity. And then finally, I'm invested with a partner that I've been in business with for 12 years, a former TCR guy, in doing student housing. And we've got a deal to the third floor being framed in Charleston now. And I think student housing, you got to be careful. You want, as if possible, a walk-to location, but you saw some of those demographics. I think there's still good demographics for student housing in the right location in a growing university that's not competing by building their own housing. So those are just some thoughts for you.
Terry, what do you see going forward in 2013?
It's kind of on the same track. We're actually focusing on the multifamily segment as well. We're a deal junkie. We go wherever the trend is. That we've been developing multifamily for some time, but we've got about 1,000 units in our pipeline. We will deliver with Jim Mahalso next week, 321 unit project in Plantation. We broke ground Monday on a 312 unit facility in Nashville, Tennessee. We're in for DRC approval in the city of Fort Lauderdale for a 289 unit apartment building at 8th Avenue in Las Olas, as well as another project in Davie. Also, again, going back to the public scenario, that's our other strategy, is to do grocery anchored shopping centers, only with Publix, being candid with you. Luckily, we're doing 3 in Charlotte, as well as next month we'll close on Sheridan and US 1 with a Publix at that location. And then also we have a small fund that we came out with, closed about a month ago, and we're hoping to take advantage of some of this debt that's coming to the marketplace. And we've already bought 1 public center in Ormond Beach, and we're looking to close that out in about probably a year and a half. One trend that we're not in that I believe is really active in our marketplace, and it was mentioned earlier, is the industrial market surrounding this new deepening and widening of the harbors to accommodate the post-Panamax ships. You're seeing a great deal of activity being generated for that. Again, we don't do it, but it sure seems like a segment that's becoming pretty active. So that's kind of our strategy.
Armando, I know Terry mentioned distressed debt. We've had a couple of brief comments on that, but what do you see out there?
My philosophy hasn't changed from the time that I sold that. We want to buy things that are, I don't want to buy anything anywhere near replacement value. We bought CDD bonds. Many of you here in the room are familiar with them. They were community development bonds issued for infrastructure. They are non-recourse to the developer, tax-free to the bond buyers. It was a very good way for developers to fund infrastructure. They come senior to the first mortgage. So we were the largest buyers of CDD bonds during the distressed times. We bought in 2 buckets. We bought in one bucket that they were defaulted and we wanted the real estate, so we would have been very happy if they paid us, or happier if they didn't pay us. And then we bought on a bucket of, I was the largest issuer of CDD bonds for commercial, for logistic parks. So our bonds never defaulted. Our bonds should have never been hit. When this bond got whacked, they all got whacked at the same time. We bought one issue in Broward County called Moderator, $129 million, ahead of a first mortgage, ahead of a mezzanine, ahead of the equity, at 68 cents on the dollar net. And we bought some in Jacksonville at 28 cents on the dollar. The 68 cents on the dollar in Broward were a better buy than the 28 in Jacksonville. The 28 in Jacksonville were 75 replacement value of the infrastructure, land free, and there's very little barriers to entry there. We succeeded thanks to Larry, so Larry was able to negotiate it so that we preserved the bonds. Moderator, we refloated the bonds at par. We downsized it to 1,652 units. And Moderator, we have sold all units except one of the models. We built all the single families ourselves, 657. We got one model left. All of the other units we sold. So we tried to buy assets in Miami. We were unable to. We're disciplined. I told my MBA to forget their spreadsheets. I wanted to buy a $50 cents on the dollar replacement value, and not to run anything other than a sale at 75%. Long story, we were unable to buy anything because prices there get heated up, and the foreigners come in and they pay more than I would pay. The only other place that we would have gone to, we went to Dallas. I've been going to AMR, American Airlines board meetings since '94, so I knew Las Colinas well. So we bought 2 buildings at 30 cents on the dollar replacement value, buildings that we're very happy with. We have acquired, nobody wanted to play in the land side, that's what we played on the bonds. When the bond play has gone away, those bonds are right price now, what they should have been, and the ones that defaulted have been taken over, or they still have problems. In the last year, we have bought approximately 10,000 units of entitled land, some of it developed, because we're a believer on that a lot of these national builders that got rid of their inventory are going to have to come to us in many places, that we would be a logical place for providing them inventory. My love would have been office and industrial, but I sold out. I didn't want to compete with Fortune. I don't have a non-compete anymore. But philosophically, I didn't want to do it, and it's very hard to find good opportunities. So we're developing and building 1,200 multifamilies, and the market has been such that we have pre-sold all of them. So we begin delivering in this quarter like 360 and 360 next quarter. But an investor firm has bought them all for us, and we have 1,000 more on the pipeline. So we're staying very disciplined. I feel a little better, but not a hell of a lot better than I felt a while ago. So we want to keep buying well below replacement value.
Great. Jim, how do you see things in 2013?
Well, thanks. Well, first of all, as a philosophy, we're not real keen on owning real estate. And the way I say that is that for 43 years, we've been through all the cycles that Ron talks about, and there are times when real estate's just upside down. You can't sell, you can't make a profit. Our goal is to make profits, and so we do it kind of backwards. We talk continuously to the buyers. We know what the buyers want. We know the product. We know the markets. Right now we're building in Orlando, Charlotte, Raleigh, San Antonio, Austin, and guess what? That's where the buyers want to buy. And so if you can build on an 8% cash-on-cash return and you can sell on a 5 cap, that's good money. And why not take your profits and do other things? Give it away to performing arts centers. But I think that we're here continuously because we have a cadre of joint venture partners that are anxious to do deals with us. We have a huge record of we've never lost capital for a partner. And so that kind of conservatism, and as Ron said, doing loans of 65% of your cost or 70%, it always works even in the down cycles. So we're busy. We believe in building and selling, and that's kind of what we do.
So you sort of have the merchant builder strategy, right?
Sort of a merchant developer, I guess.
Pat, you're the cleanup hitter. What opportunities are you seeing out there?
Well, my number one advice to everybody here, if you remember Chris Lee's slide of proofs for where we are in the cycle, Codina was selling in '98, Codina was selling in 2008, and Codina is selling. Start selling. So that's number one. Secondly, the author of the Developer's Creed, I don't remember whether he died at the end of a cycle in 2008 or 98 or 88 or 78, but when he died and he went to heaven and St. Peter's met him, and it was a time when a lot of developers had died because of all the stress, etc. St. Peter's told him, that the area reserved for developers was all filled up, and unfortunately the developer would have to go to hell. And the developer, being crafty like all of these developers up here and out there, asked St. Peter's, said, you don't mind if I say a few words to the boys up here before I head south? And St. Peter's could see no problem in it, so the developer cuts his hands and says, new development opportunity in hell, 100% financing available. And with that, every developer went south, and St. Peter's was obviously impressed. There's a lot of room, and he said, we've got plenty of room for you now, come on in here. And the developer said, there may be some truth to that rumor after all, so I think I'm going to go join the rest of the guys. So anyway, just real quick, Mitchell asked a good question, which was, in a business where a good portion of your anchor space is flat, especially if you got a great anchor like Publix, in a lot of cases the rent is flat. How do you grow your net operating income? And what we're doing is we're selling properties where we don't think we have occupancy, merchandising, being able to attract the best-in-class local, regional, and national retailers, and pricing power in order to grow NOI, and buying properties where we think we're going to have that kind of growth. We're also doing more development. We are doing some amount of development, not as much as we were at the height of the cycle, but we're more infill focused. At one time, we wanted to be Publix's and Target's largest developer, and we found that took us into too many greenfield areas where we got into a little bit of trouble. Also, we got into trouble trying to be a merchant developer as opposed to trying to develop to own core property for the long term. So we're more infill focused. The other thing that's an interesting trend that I see is we're doing a lot more mixed-use development with multifamily developers. We're developing a supermarket, whether it's a Publix or Trader Joe's or Whole Foods, on the ground floor with six or eight shops, and typically we're either have the land under control, selling the air rights to the multifamily developer, and then buying back the condominium, or we go in and buy that from the multifamily developer.
Okay, we're getting close to the adjournment hour, but I want to give the audience an opportunity for a few questions. So I think somebody back there's got microphones, but if you can sound off, please, your questions and who you'd like to address it to, or we'll assign somebody to answer. Anybody? Oh, yes, sir.
I asked a question earlier, so I didn't want to hog the microphone. But to Jim, so this is an age-old question we have: as we develop property, should we keep it or should we sell it? Regardless of how much money one has, they develop on different scales. If you, so you said rather sell the project and use the money, go on, set the Performing Arts Center aside, maybe reinvest and do more projects. But if the sale of one project isn't required in order for you to develop another one, and if you believe some of the slides and trends of Mr. Lee's comments earlier, and if you have sufficient belief in the product you build, which you've been doing so long and so successfully, why would you not want to keep more of what you develop? And then maybe, since you don't do that strategy, what do you do with the money that you receive from the sale of your projects?
Boats and airplanes. I was at a conference with Prudential one time, and they said, you developers need to put some equity into these deals. And I said, I don't have any cash. I spend all my money on airplanes and boats. They got the same laughter. Well, I think you see a divergence of opinion, and these guys are set up to own real estate. And to own real estate, you have to have an organization that continually modifies it, improves it, all those kinds of things. And we're a pretty small organization. And so I'm not sure we have a lot of that talent. Maybe we do to some degree. But in 7 years, you're functionally obsolete. The neighborhood you built in is probably going to be different. And so change happens quickly. And I've just been around long enough to know that in our case, it's smart to take our projects.
Ron, you have a comment?
Yeah, you know, that's an interesting question. I remember when I first joined Trammell Crow, Mr. Crow said the seller is always wrong. And he was a big believer in holding real estate. And my rejoinder always was, you never go broke taking a profit. And I think it depends on the circumstances of the owning entity. You know, I'm now for the first time in a position to own some properties longer term. And we are, the Crow family and I are refinancing some of our apartments, which we normally would sell, just because debt is just so good. Particularly in the apartment space, you know, the 223F HUD program, you can get 40-year debt under 3%. So I think it depends on the circumstances. I live part of the year now in the Northeast, and you know the Northeastern families are just notorious for never selling and refinancing and taking money out tax-free. That's not all bad. So I think it depends a lot on who the investors are and what their objectives are. If you're the only one in it, then, you know, and you don't need the money to do something more, then, you know, take a look and see what the opportunities to refinance and hold are, but you got to take into consideration functional obsolescence, you know, what happened in the neighborhood, et cetera, et cetera.
I think it's as important to know when to sell as it is when to get in. And it depends on what you can do with your money. The rentals that we're selling, they're really quality. We were lucky to attract a gentleman to run it, Andy Barnum, as a partner. We have great locations, but the offers that we got, I'd rather have the liquidity. At least I think liquidity is worth more today than at any time. And the kind of cap rates that they're paying for these projected rents are, I saw them at the right time. I used to get up almost literally every morning, look at the money the banks were giving to people that I knew were going to fail, and get up every morning and say, this has got to stop. So I get up every morning thinking about, should I sell or should I keep?
I think there was a question back in the corner. Can I get that right? Anybody over there, please?
We've talked a lot about the future of real estate and what it looks like. And with the lack of funds for buildings and educational projects, I wanted to see if anybody had a thought on funding of educational development, how that might be opened up in the future.
Are you talking about student housing, or are you talking about?
Talking about educational facilities, academics.
Academic
private
facilities?
partnership type things.
We have, this may be to your point, at Enterprise, we have a CDFI, Community Development Financial Institution. We make loans to charter schools and people like that. So there is some money available from some specialized nonprofits, I think, for education. I'm not sure how much or how broadly, but that's one source.
It's going to cost. Now, I don't know that the universities may be able to borrow the money cheaper than they've been giving a return to, in theory, a real estate investment trust. There's EDT, which used to be just theater, but they do things like wineries, and then you have REITs that do invest in infrastructure funds. But I'm not sure that a university can't do better by borrowing the money than the rental rate on that they'd have to pay to a real estate investor, whether private or public.
That's certainly the case with the University of Florida. I mean, on some buildings that we go forward on, we can borrow from the banks right now. It's backed up by the university, but the foundation will facilitate that, and we get very attractive interest rates. Well,
Kelley, I've got one last question. We saw the trends that Chris put up on the aging boomers, and the stat is every 10 seconds a boomer's turning 65. None of you seem to be in that space for seniors housing. I was just curious as to, do you see that as an opportunity, and are you thinking about it? Are you considering it? And if not, why?
Well, I'll lead on that one. I just did a deal, Green Bay to Chicago. We bought 1,000 units. I'm in partnership with some of my partners at JMB. And we found that to be an attractive niche. We think we bought right. And obviously there's an operating side that's a lot different than rental apartments. But I'll let people comment.
We're building one in Naples on a joint venture with a non-profit, Moorings, that they have a long history on the management and the sale of the product. So we wouldn't have done it by ourselves. And we have acquired debt in Naples at a very low basis. So we had a low basis on a lot of the land on what we're doing there.
I think, Dick, Armando is right, that it takes a skill for that type of specialized housing and then the levels that you get to along the way of aging. So I know in our case, we just don't have the talent.
It's not in our wheelhouse, and we've seen what happens when we try to compete with people that have a lot more expertise in certain areas than we do.
Yeah, we built years ago, when I was on one of my diversification modes, we built 2 or 3 of them. We learned that what we were building, which had congregate care, that there were heavy operations that we weren't experts in and didn't know very well. We do find in some parts of the country where zoning is incredibly restricted, maybe people are just afraid of kids who generally aren't in our apartments, but you can get age-restricted zoning, and so I see some people who do very well with, 55 and older with no services other than renting. So I think there are opportunities, but it is a niche that you need to understand and understand how it's different from your base business.
Okay, I want to thank everyone for being here. Just a couple of comments. Next year, we're back at the Peabody, February 27th and 28th. Thank you for being here. I want to thank the panel. Congratulations to Ron on our honor today. Tim Becker, is there any other closing comments? Otherwise, we're good? Okay, we're adjourned. Thank you very much.